Are you concerned about taxes? I am. Are you thinking about selling your home and wondering just how much of that profit is going to end up going to Uncle Sam? Well, I'm going to tell you in a minute about 2 taxes that are part of every real estate transaction and what they're going to cost you. I'm Reid Schwartz with Keller Williams Western Realty, and today I want to talk about the 2 taxes that everybody's going to pay when they sell real estate. Okay, not everyone. I'm also going to give you 2 legal loopholes to avoid paying capital gains tax. So the 2 taxes I'm talking about are the real estate excise tax, which is commonly referred to as REIT, which gets paid to the state of Washington. And then the second one is your capital gains tax, which gets paid to the IRS and helps fund our federal government. The real estate excise tax is paid on the entire purchase price of the home, and your escrow office is going to calculate that tax, and they're going to pay it as part of the closing statement when you close escrow on your house. Whereas your capital gains tax is something that is paid on the profit on your home, which is the difference between the price you paid for the home and the price you sold it for. And that tax you're going to pay to the IRS with your taxes on April 15th. And you want to consult with your tax professional, your CPA, before you do that. So the REIT is going to get paid based on a structured table that the state of Washington's put out. There's 4 tax rates. For up to the first $500,000 in sales price, you're going to pay 1.1%. And for any value above $500,000, there are 3 more tiers that you're going to pay on that portion at a higher rate. There's also, in addition to the state rate, there is a local REIT that you're going to look up on a chart, which is in the notes down below that the state of Washington's put out for each different region. In Island County, it's 0.5%, so that takes that REIT tax rate total up to 1.6% for the first $500,000. Now, conveniently, as of March 2021, the median sales price in Island County is at $499,000, up from $397,000 12 months before, which is absolutely phenomenal. So for half of you, you're only going to worry about that 1.6% or about $8,000 on a $500,000 sale. Capital gains tax is going to be paid to the IRS. You're going to file that with your taxes. You want to double check with your tax advisor or CPA when you're doing that. Make sure you let them know that. You're going to get a 1099 from the escrow office that you had that income. The capital gains tax is taxed on your profit, not on the total sales price. And the government gives you 2 great loopholes to avoid paying some of that tax, or maybe even all of it. Number 1 is the exclusion of gain. And you can get more information about this by looking at IRS publication 523. And it goes through all of the details. But the long and the short is, as long as you and your property qualify, and I'm going to give you what the qualifications are, you get a $250,000 exclusion for an individual and $500,000 for a married couple. That is an amount that you have profit that you can make on the house and not have to pay any income tax on that or capital gains. And you can do that every 2 years. So here's what the rules are. The main rules are that that needs to have been your primary residence. You need to have lived in the home for 2 of the last 5 years. You cannot have acquired the property using a 1031 exchange in the last 5 years, and you cannot have used this exclusion of gain in the last 2 years. Those are the basic rules, and then you got pocket 250, 500 grand, and you can turn around and do it again in 2 years. So a fantastic benefit that's afforded to homeowners. A great way to help build wealth. The second way to avoid paying capital gains taxes on your real estate sale It does not apply to your primary residence. It applies to investment properties, and it's a 1031 exchange. And it's a method to defer the payment of the taxes by selling one property that is an investment property and using the funds to purchase another property. There's a whole series of rules that go with it. The most important thing you need to be aware of is that you need to speak with a professional in real estate before you decide to sell the property. If you have not taken the proper steps before you sell the property, you could lose the benefit. There's a series of strict rules, and you need to understand what those are. And you need to work with a professional, not only a real estate agent that understands how it works, but also a 1031 company who is actually going to be your intermediate third party holding the funds in between transactions. It's very similar to when you transfer money from an IRA or a retirement fund into an IRA. And if you take possession of those funds, they become taxable income. Kind of the same thing. If you take possession of these funds, it becomes taxable income. Whereas if we follow the rules and use the third party, it is not taxable. So I'm more than happy to talk with you about 1031 exchange, but just be aware that it's out there. So there's your 2 legal loopholes to avoid paying capital gains taxes. So if you would like to have an additional conversation about using the 1031 exchange or about your exclusion, feel free to give me a call. I'll be more than happy to talk to you. I love nothing more than helping people build wealth in real estate. And I am Reid Schwartz, and I am with the Craig McKenzie team at Keller Williams. Have an amazing day.